So what do you think of software valuations right now?
Yeah, look, software it's exceedingly cheap, right? People focus on revenue multiples. The revenue multiples are public SaaS businesses are the cheapest they've been in 15 years. But honestly, we don't think about that. What we focus on is free cash flow multiples, and the businesses have the median businesses ramp to 20% margins, and I think the software sector is trading at 19 times, maybe 18 times free cash flow, which is I think the first time ever that it's traded at a discount to the S&P 500, which is like more like 28 times free cash flow. So it's really cheap. The public markets don't like uncertainty, and we're at a period where uncertainty is high. And so, I think it's created this kind of air pocket here. But overall, the sector seems kind of, unbelievably cheap.
So let's talk about free cash flow multiples. Where do you think the sector should be? Well, what's the Evan Scorpin number on where you think it should be compared to the S&P?
Yeah, look, over time, software should trade at a premium to the rest of the S&P 500. The growth rates of these businesses are twice as fast. The S&P is growing 7%. The median software business is still kind of double-digit growing. And the free cash flow margins here are 20%, which is nowhere near kind of mature margin levels, right? A lot of public SaaS businesses have been putting up 40% incremental margins, which kind of suggests that margins are heading in that direction. So overall, kind of a free cash flow per share within the software sector is growing meaningfully faster than the S&P 500. So over time, I think it deserves a premium multiple. But I think, people don't like this uncertainty. And so we need to get, through this period where people don't know who the winners and losers will be before you kind of see that re-rating happening.
I want to go a little bit deeper in free cash flow multiple. We haven't talked about it too much on the show here, but one question I always have is all free cash flow equal? And you have stuff like stock-based comp, which is baked into that at times. How do you think about that?
Look, we can look at free cash flow per share, or we can look at GAAP EPS per share. I think both are very reasonable metrics to look at. At times you can manipulate both of these metrics, right? GAAP is very easily to manipulate. It's been a huge issue, and pharmaceuticals and M&A GAAP has a whole variety of problems. Over time, those two metrics I think are both acceptable. I think are both reasonable. You can look at both. We focus on free cash flow per share and account for dilution in the share count growth over time. The reason is that a lot of the SBC metric is a misleading metric as well. It's options that were granted or RSUs that were granted 3 or 4 years ago show up in the metric, and so look, it's a kind of a lagging indicator, the GAAP EPS, whereas free cash flow per share is more of a leading indicator. But I think both are reasonable.
And if rates come down, does revenue multiple become more important in your mind at that point?
Revenue multiple in our mind has always been a proxy for what is the earnings power of the underlying business. And so when people bought a business that, when you talk about 6 times revenue, to me, what I hear is when the business is 30% margins, that's 20 times earnings. And when people talk about, 15 times revenue, look, I think it's what you're doing is you're saying 5 years from now, this will be 6 times revenue, and that 6 times revenue at 30% margins is 20. Like, it's always been a proxy in our mind.
Right. I want to talk about the AI story right now. So the narrative here that is AI going to eat SaaS, kill SaaS, will it replace SaaS? I mean, these are all the big questions right now. What is your perspective on that narrative, and how are you thinking about the cost savings or the potential cost savings that companies could achieve with AI?
Yeah, it's a great, and look, it's the question. I think it's worth stepping back for a moment. Software has been on a 50-year journey to replace labor, right? If you fundamentally think about what software is, we're making labor more efficient, so you need fewer people to do the same thing. We're on a 50-year journey there, and AI is the newest tool, which I think will unlock a significant growth in the software market, right? All of a sudden, software is able to now do things in that labor has done historically that software has not been able to help with. I think first and foremost, this is exciting, right? It is AI is software, right? Fundamentally, it is software. What we're doing is we're unlocking a new power within the software ecosystem. With that, yes, there will be new incumbents coming in. that are kind of, people use the word AI native all the time. There's going to be new incumbents. And there will be, there will be the original businesses, SaaS businesses that have deep relationships with their customers. And that's nothing new to the software ecosystem. There's always been new technology, which has led to new entrants into the market. And there's a duking out that needs to happen between who wins, the businesses that own the customer or these new technologies. And I think overall, though, there's this fear that this is bad for software. No, this is unlocking a lot of growth for software. And the question is, who is going to win this incremental growth? Is it going to be the installed base of software businesses which own the relationship with the customers today? Or is it going to be new entrants that the market perceives will be better able to harness this new technology? But I think this view, and the answer will be both, right? The answer will be, as with every new technology that's happened, there will be new entrants and there will be installed base that continues to gain share. And I think that people are trying to draw this black and white thing, and I just don't think it's fair.
So where do the cost savings come from then? If spending on software, whether or not it changes over time, the point you're making is that, we'll see. It's AI is software. I take your point, but is it labor budgets then where you see cost savings coming in?
Yeah, look, the software market is tiny. The average S&P 500 company spends about 3% of their OpEx budget on software. People are not excited about AI because it's going to replace Workday or Salesforce. They're just, that opportunity is not big enough, frankly. Salesforce and Workday are not big enough businesses for people to be spending $1 trillion in CapEx to displace, right? What are all the AI native businesses doing? Look at the Harveys, the Sierras of the world. They're all targeting the labor market. They're saying there's a population of people these people are, think about the software budget, 3% of the S&P 500, labor budget, much larger, orders of magnitude larger. I think it's 40 times larger, the labor market. And they're saying, look, we think we can replace customer service agents. We think we can replace junior engineers. We think replace. So it's, what are they targeting? They're saying there's a bunch of repetitive labor that we can automate.
Okay.
And will there be some collateral damage on the software market as it exists today? Maybe. But the real opportunity with AI is to expand the software market and steal share from the labor market.
So let's put aside for a moment the question about what happens to that labor. That's a whole nother topic. But now you have companies that conceivably will save money on labor, like you're saying, with these new tools. Where do they put those dollars then? What do they invest in?
Yeah, look, there's this view that, all of a sudden we'll have, labor is not going to be used anywhere and there'll be unemployment rising. I don't prescribe to that. I think we historically find ways to use resources in this country, and labor is a productive resource. And if we, can make customer service more efficient with AI, I think we'll see customer service agents shift to other jobs that are going to be productive as well. And so what are those jobs? I don't know. But we're, we end up, as we become more efficient, we use the, resources elsewhere.
But I guess what I'm getting at is what I thought you were initially saying was that it's coming for the labor market, in that you'll have cost savings there. Maybe if you had 1,000 people, now you're doing the same job with 700 people.
Yeah.
And so the question I was trying to get at was, okay, so the cost savings from those 300 people, then what do you invest in? But now what I hear you saying is that, well, no, actually you still have 1,000 people. It's just that the jobs are different. So which of those?
Okay. Yeah. Fair question. Look, some of it will flow to the bottom line, right? I think the S&P 500 is becoming, the margins of the average business S&P 500 are growing each year. And I think that'll continue. I think companies are going to get more and more efficient. So some of the savings will drop to the bottom line, and it's going to cause the S&P 500 earnings to grow, and that'll fuel the stock market for years. Others of it will be reinvested, right? People will say, hey, I'm going to turn around and take that money and I'm going to reinvest it into software, into growing my production capacity, whatever it is. It depends on the company.
Okay. How do you think about the new IPOs coming to market? OpenAI, Anthropic, SpaceX. I think Lead Edge Capital, you guys focus on a different class of businesses from what I understand. These are businesses that people don't even know the names of sometimes. People, smaller businesses that are in the background, companies that we probably never will hear of. On the other hand, you have the SpaceXs, the OpenAIs. I mean, orbital data centers. What's your view on the narratives that these companies are pitching?
Yeah, look, they're exciting. They're exciting businesses. I think we're excited. We're excited to see more of the financials of some of these businesses. I think that there's been a change in the technology ecosystem from capex light, free cash flow generative machines and software to this kind of new era of IPOs, which are capex heavy, consuming an incredible amount of cash to grow. And I don't think, investors have really been able to dig into the unit economics of that enough. And so one thing we're excited to do is to just dig in to be able to see the numbers. Right? We see the revenue growth rates, but we don't see what's happening to gross margin. We don't see what's happening to free cash flow. So I think we're excited about that. Look, I think the IPO market is going to be tricky. I think public investors have been burned investing in IPOs, and over the last 5 years. And I think we need to have some successful IPOs where people who get in on day one, day two, day three end up being really successful. And that will take time. And I'm hoping these are the investments that do it. I'm a little nervous that we're in this weird period where the valuations at the time of the IPO seem to be sky high. And then we've had a series of IPOs recently that kind of IPO at a sky high valuation. It resets later. That's not an encouraging sign for Lead Edge or other investors to step in at the time of IPO. And so hopefully we see some that kind of price at much more reasonable levels, and we see kind of a more linear rise in share price rather than this volatility, which I don't think is good for the company. I don't think it's good for the venture guys who are in the business today. I don't think it's good for employees. So I don't know how to solve it, but I think the volatility in kind of post IPO share prices is really unhealthy.
And so last question for you, what are you buying then in this environment?
Yeah, look, we've been active. We're buying, we think we're buying great businesses, sub 2% dilution, really sticky businesses, durable customer relationships, businesses that have proven they can ramp margins over the last few years. And we're buying these businesses at kind of like 10 times forward free cash flow or earnings.
Any names you can share?
Yeah, Mitchell's been on the air. We built a position in Workday recently. We have
Workday. Okay, so you guys are bullish on Workday.
We're bullish on Workday. I think it's one of the highest quality software businesses in the world. And we're in at sub 10 times free cash flow. We think, which is kind of an incredible. Who would have thought? We own Kinaxis, which is a supply chain business in Canada. We recently rebuilt a position in Toast, which I think is compounding at 20% plus, compounding at scale, fantastic margins. So we've been active in software.
But okay, so I just want to get into Workday here very quickly. I didn't know you guys were buyers of Workday. I mean, they've had this transition now with the founder step coming back. They had the layoffs. I mean, this is a company that is at the core of the question you just said, which is it the install base or is it the flashier tools that will win in this era? I mean, Workday, look, it seems like one of those tools that, you could maybe do yourself and, you have larger corporations using it. But
yeah,
help us understand your thinking here. Why are you so confident in the founder coming back and in the company?
Yeah, look, if you ask large companies, you ask Walmart, large companies, hey, could you, replace Workday with a cheaper version of Workday? They have no interest in doing that. Workday goes back to this. Software today is a very small percentage of like Walmart's OpEx base. And they have no interest in trying some vibe coded solution, which this is mission critical stuff for Walmart. And when they think about the opportunity of AI, they're saying, look, we have tens of thousands, hundreds of thousands of employees, and we're looking for our software vendors to help us get savings. But the savings opportunity that they're looking for is in labor. It's in, hey, we spend a lot on recruiting. Can we use some agentic solutions to make recruiting more efficient? To go through a massive, to replace Workday is a multi-year journey, and for what? To save a tiny amount of cost? The reality is that there's been price competition for software vendors for years, and no one wants to switch. There is cheaper versions of Workday. There's cheaper versions of Salesforce. You see very little adoption because people like using the mission critical, the very best solution. And the time and effort to switch is not worth it. What they're looking for, you talk to these customers, they're saying, look, everyone's telling me AI is so exciting. Prove it. I want anyone who can come in and actually create savings, but the savings are going to come out of the labor market. It's just 5 times bigger. It's 10 times bigger.
Great. Well, Evan, I want to thank you for coming on. That is Evan Scorpin from Lead Edge Capital here on TI TV.